While most people are panicking about the next market crash, a small group of investors is quietly getting ready for what could be the single biggest wealth building opportunity of our generation. What's the difference? They understand that major market downturns aren't just a threat, they're a scheduled transfer of wealth from the unprepared to the strategic. In this video, I'll show you exactly which side you can be on, because it's not about surviving the fall, it's about knowing how to profit on the way back up. History shows that after big declines, the market doesn't just recover, it often comes roaring back, creating a new wave of wealth in the process. The only question is, will you be ready? Let's get real. A stock market crash isn't a matter of if, but when. They are a normal, cyclical part of the economy. And while nobody can guarantee when one will hit, elevated correction risk is a recurring theme among financial experts. Since World War II, the US has experienced 12 recessions, happening on average every 6 to 7 years. Each one felt like the end of the world. The dot-com bust in 2000, the great financial crisis of 2008, the COVID-19 crash in 2020. And every single time, the headlines screamed panic, investors dumped their stocks at huge losses, and fear took over. But here's the secret the ultra wealthy have always known. These events are some of the greatest wealth building mechanisms in modern history. A crash is a fire sale on the world's greatest assets. It's when the market transfers money from the impatient and the emotional to the patient and the strategic. My name is your name. And for the past X years, I've dedicated my life to studying these cycles. I'm someone who has navigated these downturns firsthand and seen how a prepared investor can turn a crisis into a defining moment for their financial future. In this video, we're not going to talk about fear. We're going to talk about strategy. We'll break down the exact playbook that separates the victims of a crash from the victors. This isn't about risky trading or trying to perfectly time the bottom, which is nearly impossible. This is about a clear, systematic approach anyone can follow. We'll cover 4 key strategies. First, we'll decode the economic signals that can warn of a coming storm. Second, we'll build your financial fortress, the prep work that puts you in a position of power. Third, we'll get into the specific tactics, the do this part of the title, for deploying your cash when everyone else is running for the hills. And finally, we'll master the most important tool of all, your own mind. By the end of this video, a market crash will no longer be something you dread. It will be an opportunity you're ready to seize. The first step to profiting from a downturn is knowing how to spot the warning signs. No one can predict the exact day a storm will hit, but the economic sky is full of clouds that gather long before it rains. Strategic investors watch these signals not to panic, but to prepare. Let's look at 4 of the most reliable indicators. First is the inverted yield curve. It sounds complex, but it's simple. Normally, the government pays you more interest for lending it money for a long time, like 10 years, versus a short time, like 3 months. But sometimes this flips. Short-term rates become higher than long-term rates. This is an inverted yield curve, and it's one of history's most reliable recession predictors, having appeared before major downturns like the 2008 financial crisis. It signals that investors are so worried about the near term that they're piling into long-term bonds for safety. Second is the Buffett indicator. Warren Buffett himself called this ratio the best single measure of where valuations stand at any given moment. It compares the total value of the stock market to the country's economic output, GDP. Think of it as the market's price tag versus what the economy is actually producing. When this indicator gets really high, historically a reading over 150% suggests stocks might be overvalued, it's a sign of what former Fed Chair Alan Greenspan called irrational exuberance. It's not a short-term timing tool, but it's a great gauge of whether the market is playing with fire. Third, watch the volatility index, or VIX. Known as the fear index, the VIX measures the market's expectation of volatility for the next 30 days. A low VIX under 20 suggests calm. But when the VIX starts climbing, especially if it spikes above 30, it's a clear sign that fear and uncertainty are taking hold. A sudden spike in the VIX often happens right before a sharp market drop because it shows rising investor anxiety, which can quickly turn into panic selling. It's the market's way of saying, I'm getting nervous. The fourth and final signal is a mix of slowing economic data, specifically declining GDP growth and rising unemployment. A country's GDP is its economic engine. When it sputters, corporate profits tend to follow. If you see consistent reports of slowing GDP and a rising unemployment rate, it's a classic sign the economy is weakening. When businesses stop growing, they stop hiring and start laying people off. This cuts consumer spending, which hurts more businesses, creating a negative loop that often leads to a market downturn. Individually, any one of these might be just noise. But when you see them together, an inverted yield curve, a sky-high Buffett indicator, a rising VIX, and weak economic data, the message gets clearer. The weather is changing. It's time to stop chasing prices and start preparing your shelter. This isn't about panic selling. It's about shifting your mindset from accumulation to strategic preparation. Seeing the storm clouds is one thing, having a fortress to weather the storm is another. This is where the unprepared get wiped out, but the strategics set themselves up for victory. Preparation isn't about risky financial products, it's about two simple, powerful assets, cash and a plan. The single most important thing to have before a market crash is liquidity. That means cash. While everyone else is fully invested, watching their portfolios bleed red ink, the prepared investor has a war chest of cash ready to go. During a crash, cash is no longer boring. It becomes your ultimate tool of opportunity. It gives you the power to buy the world's best companies at prices you might not see again for years. Think of it this way. When your favorite store has a 50% off sale, you don't panic. You get excited and head to the store with your wallet ready. A market crash is the same idea. It's a flash sale on great investments, but you can't take advantage of a sale if your wallet is empty. Building an emergency fund of at least 3 to 6 months of living expenses is step one. This ensures that if you get hit with a job loss, you won't be forced to sell your investments at the worst possible time to cover your bills. Being forced to sell is how you lock in permanent losses. Beyond your emergency fund, you should strategically build your cash position as market valuations get stretched and those warning signs appear. This might mean trimming some profits from high-flying stocks or putting new contributions into a high-yield savings account instead of the market. It feels wrong when everyone is bullish, but this is the discipline that separates amateurs from pros. Warren Buffett is famous for letting Berkshire Hathaway's cash pile grow when he sees no good value in the market. He's preparing his war chest for the next big sale. Now, having cash is only half the battle. You also need a shopping list of dream assets. During the chaos of a crash, the last thing you want to do is start frantically researching what to buy. Your decisions will be clouded by emotion. The time for homework is now, when things are calm. Create a watch list of 10 to 20 high-quality companies and ETFs you would love to own if their prices were much lower. What makes a company high quality? Look for businesses with strong fundamentals, a history of consistent profits, low debt, a durable competitive advantage, what Buffett calls a moat, and great management. These are the companies strong enough to survive a recession and thrive on the other side. They are blue chip stocks that often continue to pay dividends, giving you income while you wait for the recovery. For most people, the best approach is to focus on broad market exchange traded funds, ETFs, like one that tracks the S&P 500. This gives you instant diversification, removing the risk of picking one stock that might not bounce back. Your list could include an S&P 500 ETF, a NASDAQ 100 ETF for tech, and maybe a few individual stocks you truly understand. For each asset, set target buy prices. For example, you might decide to start buying an S&P 500 ETF if the market drops 20%, and buy more aggressively if it drops 30% or 40%. Having these preset levels takes the emotion out of the equation. When the market hits your price, you don't have to think, you just execute. This prep phase is what lets you act with clarity when everyone else is paralyzed by fear. You have your cash ready and your shopping list in hand. While the world sees a crisis, you see a once-in-a-decade opportunity. You've read the signals. You've built your fortress of cash and a detailed shopping list. Now, the crash is here. The market is down 20%, maybe 30%. News channels are a sea of red. Your friends are talking about selling. This is the moment of truth. This is where you execute. The main tactic here is one of the simplest yet most powerful strategies ever created: dollar cost averaging, DCA. Dollar cost averaging means investing a fixed amount of money at regular intervals, no matter what the market is doing. Many people do this in their retirement accounts already, but using DCA with your cash reserves during a crash is a game changer. It's a systematic way to buy assets on sale and removes the impossible task of trying to time the absolute bottom. Here's how it works in a crash. Let's say you have a $20,000 war chest. The market has officially entered a bear market, down 20%. Instead of throwing all $20,000 in at once, you break it up. You decide to invest $2,000 every 2 weeks for the next 10 weeks. In week one, the ETF you want is at $80. Your $2,000 buys 25 shares. 2 weeks later, panic has grown and the market is down 30%. The share price has dropped to $70. Your next $2,000 now buys you about 28.5 shares. 2 weeks after that, there's a small rally. The price is now $75. Your $2,000 gets you 26.6 shares. See what's happening? By investing a fixed amount, you automatically buy more shares when prices are low and fewer when they're high. This lowers your average cost per share and takes emotion out of the driver's seat. You don't have to worry about buying at the absolute bottom. In fact, you should hope you don't, because it means you got to buy at several low points on the way down. You can even set up a tiered DCA strategy. Market drop of 20%, deploy 25% of your cash. Market drop of 30%, deploy another 35% of your cash. Market drop of 40% or more, deploy the final 40%. This is a structured way to be greedy when others are fearful, as Buffett advises, without going all in too early. This strategy works. Investors who used DCA during the 2008 financial crisis or the 2020 COVID crash saw phenomenal returns. In 2020, those who panicked and sold locked in awful losses, but those who had cash and started buying saw their investments soar as the market staged one of its fastest recoveries. Remember, history is on your side. After the 10 worst single-day drops in the S&P 500's history, the market was higher 1 year later in nearly every instance, often with huge double-digit returns. It's a powerful reminder that market declines are temporary, but the growth of great economies is long-term. With dollar cost averaging, you're not trying to be a hero and catch a falling knife. You're being a disciplined strategist, accumulating quality assets at a discount. We've covered the signals, preparation, and tactics, but I've saved the most important strategy for last. Without this, everything else falls apart. You can have all the knowledge, all the cash, and the perfect plan, but if you don't master your own psychology, you will fail. The battle for wealth during a crash isn't fought on a stock chart, it's fought in the 6 inches between your ears. Our brains are wired for survival, not for investing. When we see a threat, like our life savings disappearing, our primal instincts kick in. It screams, sell, get out, protect what's left. This is panic selling, the single most destructive force in investing. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient. During a crash, this becomes painfully obvious." Let's picture 2 investors. Investor A hasn't mastered their mindset. When the market drops 20%, they feel sick. The red on their screen triggers memories of 2008 headlines. When it falls to 30% down, fear turns to panic. I have to get out before it goes to zero, they think. They sell everything, locking in a 30% loss. They feel relief for a moment, but then sit on the sidelines, too scared to get back in and miss the biggest recovery gains. Investor B has mastered their mindset. When the market drops 20%, they feel the same fear. That's human. But instead of letting fear drive, they look at their plan. The plan says, the market is on sale. Time to execute strategy 3. They take a deep breath and make their first DCA purchase. When the market drops 30%, the fear is still there, but their conviction is stronger. They remember another piece of Buffett's advice. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. They make their second, larger purchase. They are acting, not reacting. The difference, investor B had a system to override emotional impulses. You must build this for yourself. The key is to change your perspective. View volatility not as a threat, but as an opportunity. Bad news is your best friend because it lets you buy a piece of the future at a discount. Here are 3 practical ways to build this mental strength. Stop looking at your portfolio every day. During a crash, checking your balance constantly is like picking at a wound. It just feeds anxiety and the temptation to do something stupid. Study history. Look at charts of the 1987 crash, the 2000 dot-com bust, and the 2008 and 2020 crashes. In every case, the market recovered and hit new all-time highs. The downturns look like tiny blips on a long-term chart. Create an anti-panic document. Write down your long-term goals and the historical data that proves staying the course is the right move. Include quotes from investors you admire. When you feel that fear creeping in, read this document. It will be your anchor in the storm. Winning the inner game is about choosing discipline over impulse, logic over emotion, and courage over fear. It's the final crucial step in turning a market crash from a disaster into a victory. So let's put it all together. Major market downturns are a fact of life for investors, but for you, it can be different. It doesn't have to be a moment of fear, but a moment of opportunity, because you now have the playbook. First, you know how to read the signals. The inverted yield curve, the Buffett indicator, the VIX, and weakening economic data. They are your early warning system. Second, you know how to build your fortress. You'll have a war chest of cash and a shopping list of quality assets you're excited to own. Third, you have your tactics. You'll use a disciplined dollar cost averaging strategy to buy into the fear systematically and smartly. And most importantly, you will master your mindset. You'll be the calm in the chaos, the strategist among the scared, the investor who is greedy when others are fearful. This is how you don't just survive the next crash. This is how you thrive. This is how wealth is transferred. The choice of which side you'll be on is entirely yours, and the work starts now. If you found this guide valuable, subscribe to the channel and hit that notification bell. I have more content on the way to help you feel informed and in control of your money. As your next step, I highly recommend watching my video on relevant next video, e.g., the 5 ETFs I'm buying in the next crash. It's the perfect follow-up to what we've talked about today. Thanks for watching. Stay disciplined, stay prepared, and I'll see you in the next video.